he was saying like, how do you figure what type of synthetic when you're putting on a synthetic, how far to go out? I said this to explain this to you guys before, but I'll explain it real quick. So if he's watching a replay, he'll understand. It depends. It all starts with, and I do this with a credit. That's number one. I want to get paid to play. The if I'm playing a move up, like let's say NUGT, okay. Well, I got paid to play, so let's look at that position real quick. Okay, you guys can see that, I'm sure. So, so NUGT position right here. NUGT is costing me $33,586 to put that position on for 10 lots. Okay. All right. And let's see. Okay. So I took in 672 on the puts. These are the costs. I paid $695 for the calls, and I took in $3 for the short calls. I'm going to explain this first, and then we'll go why I picked these strikes and why I picked the expiration. So let's do the math real quick. So 695 is the call cost. They're 790. 290, let's say 295 is the short call. They're 350. So 695 minus 295 is $4. But I took in 673. 673 minus 4 is 373. Let's say 375. First question, am I comfortable buying NUGT 75 minus 375 if today was expiration and it was under 75? The answer is yes. Number one. Number two, okay, for 10 options at 373, that's $3,750 that I'm taking in. It's costing me $33,586 to put this position on for some reason. It's pretty high, but it is what it is. So 3,750 on 33,000 is about 11%. So assuming nothing happens and all of these options expire worthless, all of them. So how's that going to happen? Well, what if it's between 75 and 80? All these options are going to expire worthless. Puts are going to expire worthless. Calls are going to expire worthless. And short calls are going to expire worthless. Okay, well, that's 11%. So for 58 days on $33,000, 11% makes sense to me. That's the second factor. Now, the key factor is how do I pick my strike and how do I pick my duration? Okay, so let's look at NUGT. Here's NUGT. All right. Technically wonderful. MACD turning up from pulling back to zero. Been going sideways for 5 weeks. This looks technically as good a setup as I can have. Now, I will add to this, by the way, on the breakout now, but I will do it with different strikes. I will go to 80 puts, 90 calls, 105 calls, but I will change the strikes. What I'm saying is that, though, at the moment, I looked at it, and I'm like, okay, so this is how I measure, by the way, folks. You guys need to understand there's measurement tools. You can do this. It's not exactly Fibonacci levels, but I've been measuring like this for a long, long time. So the last low, I go to the last low, which is 60 on NUGT. The high is 82. That's 22 points. This is the bottom. The risk on this trade is going below 70. If this thing goes below 70, I'm out of there. I'm taking my loss. I'm out of there. I'm not going to hold the bag. So I take 20. So 60 to 82 is 22. I take 22, put it on 70. That's 92. That's why I sold the 95 calls, because on this leg up, if we do break out, we're going to go to 92. And I'm going to suck all that juice out of that spread, all of it. It's under 95, right? But the 80 calls are going to be like $13, $14, and the 95 calls are going to expire worthless. And out of this type of sideways pattern with this kind of move that I'm seeing, The reason I went to September, not August, is because it may go sideways maybe another week or two, and I didn't want to have too much data decay, and that's why I went to September. I'm giving myself all the chance, time-wise, for this to work out. That's the reason, new member. Hopefully you're listening. And my goal in this is this, I definitely add. So if we do go a break above 83, then I'll sell the 80 puts, buy the 90 calls, sell the 105 calls. It'll keep it wide. But the initial short call side of it, the 95 call, was picked because I measured to the 92. And I measured it. I picked the strike that's just above it, which was 95. So I took in $3. If this stick breaks out and I took in 375. If it breaks out and goes to 92, and it'll be in quick order, by the way. It'll be like something like this. Okay? But I didn't do August because I'm going like, well, is it going to do it, or is it going to do one more hiccup, a little bit more sideways, and then go? The longer this goes sideways, the more violent the break is going to be. My point in all of this is I pick my stuff after I measure it, what kind of move I'm expecting, magnitude, and what kind of time frame I'm expecting. If I was putting this trade on here, I still would do September. But now that I did it a couple of days ago, after it's already gone sideways, literally, I mean, this thing has been going sideways 1, 2, 3, 4, 5, 6 weeks. This is the 7th week. We better get going. And that's how I do it. That's how I look at it. That's how I pick my synthetics. And you could have said, well, why are you selling the calls? Right? Well, why not? I'm measuring to 92. I'm selling 95 calls. Even if I buy the puts back, sell the calls, I may leave the calls naked, actually, and suck all the premium out of that too. Depends. Another thing I may do is stock goes to 88, maybe somewhere in that range. I will just sell the calls and then leave the puts alone, leave the calls low, naked calls alone, and it'll be a strangle. Short strangle. I have so many different ways of turning this around. Not around. It's not like a money loser or anything. I have so many ways I can do this, like I did with TSSI. First, I sold the long calls. I bought them at 3. I was selling them at 6. Right? And then buying back the puts at the same time at 50, 60 off. And then, I was losing maybe a little bit on the calls. But I waited for a little bit of a pullback and bought the calls back and left it alone. I was actually going to leave it a strangle. But TSSI is so wild, 20, 30 body, the width was not comfortable for me. That thing could go to 35, 40, and I don't want to hold the bag. I don't want to roll. I don't want a headache. I take this, I sucked all the juice out of it. But on this one, this is gold. This is not TSSI. So I may actually sell the calls 5 at 5 first. But I'm hoping it gives me a chance to add, first of all. But if we do break out and I don't add, the calls will be sold first and leave the 75, 95 strangle, naked strangle, and then collect more data out of it and then close it out. But that's the rule of thumb when I do it, how I do it. Why do I pick that strike? Why do I pick that expiration? That's the way I look at it. Hopefully that answered that question.
So when you look at NUGT's chart here, Serge,
what am I doing?
When I'm saying when you look at it, you were talking about like the 22-point jump from the lower Bollinger to the upper. But the last time,
so let's do this measurement. Let's see how close it's going to get.
That was, I think I measured it to be like 32, just above that.
Okay, so 47 to 79, 80, let's say. That's 33, 32, 33.
Yeah.
And from this low, 57, 33 is what? 80. Well, 30 would be 87. And it got to about 83. That's a pretty sharp one, though. Let's measure. Okay, let's measure these. Do you see this? This higher highs, higher lows?
Mm-hmm.
Okay, so do the measurement on that. Do the measurement on an uptrend like that. So 38.50
right
to 51.
That's around 13.
Let's say 12. 39 to 12.
Yeah.
42.12 is 54. That's 55. 55 to, and the measurement should be from here. So 42 to 55, 13. 46 plus 13 is 59. And that's 60 right there. So, with a little 2%, 3% deviation. But that's how I measure things on the way down and on the way up, by the way. So, especially if you catch a trend, that's how things move. Things don't move, I mean, sometimes they go straight line or whatever. So that's the reason for this trade. For the many other synthetics that I've done, my key is I gotta get paid to play. Worst comes worst, I wait for 50. How many days is there in this thing, in this cycle? 58 days. Okay, I'm tying up $33,600. 11% return if it's between 75 and 80, which I doubt it will be. But let's say it is. So I do all the scenarios in my head. Okay? So 11%, 58 days, 5.5% in a month. That's pretty good return.
Yeah.
For doing nothing. And my loss ratio, by the way, so you're gonna say, well, what if it breaks down? I go, granted, it could. It definitely could. Well, how do I remedy that situation? You guys should know this by now. Hopefully, maybe. Okay, so I'm breaking down. How do I don't want to get out. I don't want to get out, but I want to limit my loss. What do I do? Rook, do you know?
Yeah, you probably stop at the 70 level looking at this chart.
No, I don't want to stop I don't want to get out of the existing position. How do I minimize my risk? How do I minimize my risk? I don't eliminate the risk, but how do I minimize my risk? What can I do with the same option? Not same strike, obviously, but I'm giving you a hint. Same expiration. What can I do to minimize the loss in this position? And it could go to 60, and I won't lose more than the first day that I put that single position on.
Would you just buy some puts?
Yeah, which puts do I buy?
Well, you buy the same expiration, right?
Yes. But what strike do I buy?
Well, I would guess probably like 70.
100%. Perfect answer. Why?
Yeah.
Then it becomes a put credit spread.
Right.
Okay. So all I can lose is the difference between 75 and 70. Right. I can't lose. I could go to 10. Can't lose more than that. So if this is not a capital efficient situation for you guys, this exact same position, what you could do, and I will actually show you guys that. Let's do that. You could sell a put credit spread, right? And then take that money, and then maybe just buy, buy a call debit spread. See, on my position, the requirement is $33,000 for 10, so that means $3,300 for each. That includes the premium, by the way. So let's do that. Let's actually look at the same thing with a put credit spread as opposed to anything else. So sell the 75 put, buy the 70 call, buy the 80 call, and sell the 95 call. See? Okay. So that's 225 debit now. I don't have credit anymore because the position has moved. If I had done this a couple of days ago before I moved $5, I assure you would have done it with a credit, right? And now you have limited risk. But let's put the position on now and let's see what the requirement is going to be, okay? You guys see the requirement for 5 options? $3,633 as opposed to $12,000 the way I have it set up. See how much more capital efficient this is, doing a put credit spread and paying for the call debit spread? In fact, now that it has moved up, let's do that. Let's do something different. Let's see if we can do this with a credit. Stock is where? 79? Okay. Let's sell the 80 puts. Sell the 80 puts. Buy the 75 puts. Let's buy the 85 calls. and sell the 100 calls. There you go. Now we're down to 80-cent debit. Okay. Or if we were to do this with a credit, all we have to do is instead of doing the 100 calls, let's sell the 95 calls. Boom. Even money or a credit. And capital efficiency, it only costs you $3,300 to put this position on. Max loss is $5. You can't lose more than that. That's the difference between 80 and 75. But max gain is 10. 2 to 1. Max loss versus max gain. That's the difference between your 80 and 90. 85 and 95. And the capital efficiency of this is it's like 10%. This is for 5 options. So I'm auto 5. For one option to do this, it's going to take you $600. I mean, yeah. Look how much more capital efficient this is to do it with selling a put credit spread and buying a credit spread with that versus what I did, my knucklehead. But then I have the money to do it, so I can do it. That's the advantage of having, the account size and go for it, right?
Yeah. You also said you wanted to be really aggressive with this one.
Yes. So yeah, there's many ways of structuring the same trade that I'm doing, but do with limited risk, limited downside, plenty of upside, right? So, and so much more capital efficient. I mean, I'm looking at it, $33,526 is taking me. And why is that, by the way? What the fuck? Oh, there you go. Okay. Well, it's not just the 20% in and out. It's also on top of that 50% more. Yeah, okay. That's expected. Is that expecting volatility? Okay, fine. All right. But you guys understand, right? So hopefully that answered that question. And obviously this is going off of gold. I mean, how much more sideways can we go? The moving averages have caught up. MACD is turning up from 0 again. This has been sideways since April. It's going to be an epic run. Like I'm talking, if it does break out, it's going to be epic. Where gold's gone to 4,000. You guys see this pattern right here? This is the same kind of pattern, like 4 or 5 months. And I could draw the lines, but I'm not gonna. There's a wedge here and it broke out. And you guys see that run? And I expect something like that. And yeah, so we'll see.
So Sergio, if you wanted to do this trade on Robinhood with your account, what would you do? Would you just simply buy calls?
Oh, no, I can do the same thing. You would
do a spread, right.
Yeah, put credit spread, buy a call debit spread, and $600.
Yeah.
Now, I don't know if Robinhood's requirements are the same as TOS, but I'm assuming I can do like with my money. I think I have like 5,000 cash. I would do like maybe 3, maybe 2 or 3.
Right.
Right. I wouldn't buy calls. No.
Right.
Because there is a chance this thing is going to keep going sideways.
Right.
I doubt it. I'm looking for like a massive run here in gold because I'm looking at DXY. You guys should always keep an eye on that. DXY is the dollar index. Death. You guys see this rollover? It bounced. So this is the dollar index. It bounced exactly to where it should bounce to. Lower lows, lower highs, right? Next leg down, gold is doing this, and while this is doing this. And you guys look at this chart, right? This is the dollar index versus the gold chart. Inverse. And when the dollar was going up, right? In fact, we can superimpose it. Let's look at gold. So dollar index rallied from September 16th all the way to December, end of December. Let's see what gold did in that time. It probably still went up. Not really. What did it do? Sideways. This is September 16th to the end of the year, right here. It's just sideways while the dollar is going up. And then when the dollar started going down, what did gold do? Right? Higher. Now, all dollar needs to do is make an lower low and take another leg down. This will just fly. Hopefully fly. No guarantees, of course.